Hello, Baker investment students. So everybody had a good weekend, and I'm looking forward to the week ahead. So this week, my opinion, you actually get a little bit of break, so that's a good thing. So we're actually approaching the halfway point or midpoint of the course, if you think about it, in the middle of week 4. So this week you will just have your readings from chapter 8 and 9. I'll talk about that in a little bit. You'll have the looks like 5 homework problems. We'll have 8.5, 8.13, 8.15, 9.3, and 9.7. And then, of course, your exam. So I'll have the exam out there by Wednesday. I'll probably post it late Tuesday night. I just want to make sure everything's good and ready for it, and then I'll get it posted. And how that will work is there's multiple choice questions and an essay question, a short essay question. So I'll just ask that you either scan the document with your answers, or just put it on a one-page Word document, just no spaces in between, but just you would put like 1 is C, 2 is C, 3 is C, all the way down. Just make sure you match up correctly to the questions. So, and other than that, I'll try to get everything graded from week 3 as soon as possible. I will be out of town towards the end of the week, so I probably won't get next week's mini lecture posted till late Sunday night the next weekend. But if you do have any questions, do email me. But for this week's readings, chapter 8 and 9. Chapter 8, we look at stock valuation. Page 311, you're going to look at the Gordon Growth dividend model. It's a very simplified model that says, hey, if we have a dividend, a dividend 1 year from now, and divide that by some required rate of return or growth rate, that can give me, as long as we make these assumptions about a perpetuity about these growth rates and the dividends, it's saying, what should I be willing to pay for that stock today? Of course, one of the problems with that model is that often companies rarely change their dividend, and they do so very gradually. So, but it gives us a foundation. Better part of the chapter deals more realistically. What a lot of analysts will do is they will try to forecast out, they'll do pro forma statements and forecast out income statements maybe for 5 years, and either by percent of sales method or what they project as growth, and then they get to some terminal value in that 5th year and say, as long as this continues on for infinity, I can discount all those cash flows back to today and saying, hey, here's what all those cash flows are worth, and here's the number of shares that are outstanding in the market. If I take what that is worth divided by the number of shares, that should tell me what the stock price is worth today. And if the worth is greater than what it's trading at in the market now, you say it's worth 60, it's trading at 50, that would indicate a buy. But if it's the opposite, if you say it's worth 50 and it's trading at 60, it's saying, well, no, I would sell it because it's overvalued in the market. And a lot of this goes back to William Sharp's CAPM model. You'll see that in your reading, where they have the risk-free rate plus beta times the difference between the market return and risk-free return, is that idea of security market line. Markets should adjust based on the risk you're taking out with that company. Models are never going to be perfect, but in theory, it should adjust back to the proper price based on what those future expected returns should be. So you're going to learn about some other variables too. They talk about earnings per share, some other models of trying to predict, but it's not an exact science. I remember sometimes talking to analysts in the past. They do their due diligence, try to find out about as much information as they can, but that kind of leads to the next chapter and talks more about efficient market hypothesis, and that goes back to Eugene Fama that came up with this theory. It's still theory debated today, but he said from a weak form to a semi-strong to strong form, and it's a way to say that markets, questions that whether they're rational or irrational, Eugene Fama would say that, hey, it's rational, and it's saying that you can't use past behavior to try to predict the future of a company and the price. They're not patterns. You'll read about this in the chapter about charting and things like that, but probably most in academia and finance would say that that's baloney. You can't use some chart that looks at this and say the stock is ready to break out and you should be buying it. It should be based more on fundamentals, what we call fundamental analysis, what we have you do in academia. But because so many people do it, we have to recognize it and know that it exists. And then the semi-strong is what we're used to, is that, you all have been reading about current events in the news and about different companies, and as soon as that news is released, the stock price is instantly adjusted. It's really hard to try to get in and outcompete everybody else, because everybody's competing for that same information. In fact, I'll use an analogy I like to use of going to the grocery store. When you have your cart and your groceries there, everybody's looking at the different lines and seeing which line is the shortest. So what happens is you typically get in a line, and now these other lines are moving faster than the one you got into. So it's saying that because so many people are competing for that same information about the value of a company, that's why the argument a lot of times is just don't sweat it, just invest in the S&P 500 index fund. It's hard for professionals to beat that index. So when you get all those choice of mutual funds and what should I invest in work, I just say bottom line, do the S&P index 500. It doesn't have a lot of fees with it. I always wanted to be a manager in S&P 500 index fund because there's no rocket science to it. It's just you just buy those same stocks. They're the S&P 500 and just let it ride. So, and then the strong form even just says that even managers or those executives at the top, they have to release information with the SEC before they buy and sell stocks. So they don't have that opportunity to take advantage of that. And you've heard stories in the past about people getting in trouble or insider trading or Martha Stewart. So the government really stresses that they want to try to make sure the markets are efficient and fair. So that way people invest in markets. They felt that markets were rigged. They would not be willing to give money to capital markets. So, but you're going to find some interesting things too. It's going back to that concept where the people are irrational or rational when it comes to money. And there's certain things like in behavioral finance. I really like Richard Thaler. He wrote a book called Nudge. But kind of looking at the two schools of thoughts, rational economists say that people are logical. They're thinking all the time about how their decisions impact them. The irrational or behavioral economists say that, no, people aren't rational, and sometimes they don't make logical decisions. And some examples, one I like in the book was about anchoring, about present bias of information. They've done experiments, and some of these I find interesting, but they'll have like two groups, or a group sit down together at a table. They'll put a wine bottle in front of them, and they'll ask them to bid on how much they'd be willing to pay for that wine bottle. And just right before they do that, they asked them, okay, write down your last two digits of your Social Security number. And what they find is those people that have higher Social Security numbers, the last two digits, 89, 95, whatever it be, they are willing to pay more for that wine bottle. And those that are willing to have lower numbers are willing to pay less. But it's something that just influences your decision. That's what MBA students, I guess, should be doing, is trying to figure out ways to market things to people that they don't need. But, so do these things exist? Are there anomalies in markets, like January effect, that people are dumping stocks and it's a good opportunity to buy, or that small cap stocks, we talked about, worth $2 billion or less, those historically outperform other types of stocks. So you would think that everybody would just buy large small cap stocks to get the big return, but not everybody's willing to take on that risk too. So, but if it held true, it was efficient, people would understand that the small cap stocks would give a great return, and then everybody started buying it and their price would go up. So you would not have that opportunity. So I think you'll find that last chapter pretty interesting reading, and they'll have some other things in there too. But other than that, I'm going to keep it brief this week. So again, I'll try to have that exam out there by Wednesday, like probably Tuesday night late, to make sure it's ready to go. But hopefully it should be a little bit lighter week, give you a little bit of break, and then we'll quickly be wrapping up the course in the last 3 weeks. So have a great week. Hopefully those Chiefs can get a win next weekend, and we'll talk to you online. Take care.